the catastrophic decline in the gold price. Really? What's your time frame?
Yeah.
I began saving in gold. Gold was at $250 an ounce. The Turkish central bank has saved in gold for 10 or 12 years. They had access to the money. People line up to buy gold at 5,200 and then panic out of it at 4,500. Manic depressive behavior.
What do you think, Rick, really happened with the gold and silver pullback? Is this Gulf investors or sovereign funds selling gold to raise liquidity?
I own gold as a store of value, as insurance. I save in gold. I maintain liquidity in US dollars. I had to ask myself, is silver the best place to express my speculative technique? And the answer became no. Paradoxically, the silver stocks became better speculations than silver itself. I sold my silver and transferred the money into silver stocks. If the silver price continued to go up, the silver stocks would express that. Ironically, if silver traded sideways, the silver stocks were priced in the market to discount $45 silver. So the better silver stocks could go up even if the silver price didn't go up.
Let's start with gold. The news I saw today is that the Turkish central bank sold nearly 60 tons of gold. My first question, what do you think was the rationale behind that move? I'm hearing that Dubai is in the mix, or is this profit-taking? What's this, Rick?
I don't know. But obviously for the Turks, gold served its purpose. Gold is the ultimate liquidity. So I can assume at the outset that the Turks needed the money for some reason. Because the Turkish central bank has saved in gold, for some time they had access to the money. You know, one wouldn't describe Turkey for the last 20 years as being fiscally particularly well run. And I'm fairly certain that if the Turks went into international bond markets to sell lira-denominated bonds, they would have a very difficult time raising money, given their track record managing the lira. The fact that the Turks saved in gold and had access to the liquidity at this point in time, despite the overall mismanagement of their currency and their economy, says a lot about gold. Says something about the Turks, too, but it says a lot about gold. I think people need to realize this. I see this discussion, Lucian, on the internet about the catastrophic decline in the gold price. Really? What's your time frame?
Yeah.
I began saving in gold religiously in the year 2000. Gold was at $250 an ounce. When I look at the current gold price and people tell me the gold's down, I sort of shake my head.
The headline says gold is down, but the reality is more nuanced. As Rick Rule points out here, the Turkish central bank's sale of 60 tons highlights gold's role as ultimate liquidity, especially for a country struggling with fiscal mismanagement. Over 20 years of gold savings gave Turkey a safety net unavailable through bonds, a detail markets rarely consider. Long-term investors should note that short-term price chatter masks gold's real-world utility and historical value. Next, Rick Rule unravels the implications of market perception versus tangible gold liquidity for global portfolios.
Yes, I understand if you got high-sided in gold. If you waited until 5,000 or 5,100 US to buy it, you're disappointed. It's interesting, we can talk about it later in the interviews, that people line up to buy gold at 5,200 and then panic out of it at 4,500. Manic depressive behavior and the type of behavior evidenced by other people that's been responsible for a fair bit of the money I have now. One is supposed to buy low and sell high, and people are exhibiting different behavior. Not to say the Turks did. You know, the Turks have been consistent buyers of gold for 10 or 12 years, and I assume they did, assuming that the reports are correct, that the Turkish central bank sold the gold, they did fairly well on it, and I would assume that they sold it for the most obvious of all reasons, which is to say they needed the money.
Yeah, what do you think, Rick, really happened with the gold and silver pullback? Is this Gulf investors or sovereign funds selling gold to raise liquidity or something else? What do you really think?
I think some of that is. I think that we are coming into a period of greatly diminished liquidity. Capital markets are beginning to freeze. Counterparties don't trust each other. We watched this happen in 2008. I'm not suggesting it's going to get that bad. But the other thing is that I think the upside rally exhausted itself.
Investor panic at 5,200, then fleeing at 4,500 shows behavior often overlooked. As Rick Rule points out here, diminished liquidity is creeping into markets, echoing 2008 counterparty distrust. Turkey's steady gold purchases stand in contrast, illustrating disciplined capital preservation. Most retail panic ignores that institutional and sovereign funds move for liquidity reasons, not sentiment. Understanding these patterns helps investors avoid emotional traps. Next, Rick Rule discusses the subtleties of gold and silver pullbacks in relation to global liquidity constraints.
The year 2025 was one of the best years on record for the gold price increase, and I think we ran out of buyers for a while. Something else happened, Lucian, which is that perversely, the war generated a circumstance where the US dollar prospered. The DXY, the exchange traded product that measures the dollar versus other currencies, has been soaring. And US long-term interest rates, despite Mr. Trump's best efforts to bring them down, have gone up. That higher yield relative to other countries' currencies, in particular the euro, has meant that the US dollar has been relatively attractive. So the US dollar gold price has declined, both because we ran out of buyers. We had some, I suspect, liquidity-driven sellers, countries in particular that had no current access to credit markets, and the fact that perversely the US dollar became stronger during the war. I would point out, Lucian, and we have talked about this in prior interviews, that major cyclical declines can occur in secular bull markets without derailing the market. In the period 1970 to 1980, which I remember well, a period for reference that saw the gold price go from $35 an ounce to $850 US an ounce, a 20-something fold increase. There were at least 4 instances in that decade where the gold price fell by 25% or more.
Record gold gains in 2025 obscure the reality that US dollar strength during geopolitical conflicts pressures bullion prices. As Rick Rule points out here, liquidity-driven selling by countries without credit access compounds the effect, masking the broader secular bull trend. Historical cycles from 1970 to 1980 show 25% plus drops do not derail growth, reminding investors that volatility is expected. Portfolio strategy must consider currency impacts, alongside gold fundamentals. Next, Rick Rule shows why cyclical dips in a bull market are opportunities rather than panic triggers.
There was one in 1975 where, if my memory serves me correctly, the gold price fell by 50% without derailing the gold bull market. So what we have seen very recently is completely consistent with gold market behavior in bull or bear markets. What it has done is unnerved the recent fans of gold.
Rick, let's move to silver. If I recall correctly, you reduced some of your physical silver exposure around stronger price levels. Would you consider reconsider re-entering at current prices? We have silver at, I believe, $68 today. And what conditions would need to be in place for that?
My physical silver occupied a portion of my speculative portfolio. And it's important to note that. I own gold, probably for the same reason the Turkish Central Bank did. I owned it as a store of value, as insurance. I save in gold. I maintain liquidity in US dollars. Silver was very, very different. I owned it as a speculation. I owned it because it was hated. When you and I first began to interview, the silver price was about $20. And if you read speculator comments online about silver, they were either people who got shaken out of the silver squeeze and hated it, or at the very best, they were bored by it.
Dollar strength and rising US yields are quietly pressuring gold, yet most commentary focuses on headline drops. As Rick Rule points out here, cyclical declines in secular bull markets, including 25 to 50% dips historically, do not derail long-term trends. Silver behaves differently. Held as speculation rather than insurance, it reflects market sentiment rather than store of value dynamics. Investors chasing headline numbers risk mistiming entries, especially with silver's volatile speculative profile. Next, Rick Rule discusses why differentiating gold as insurance and silver as speculation is critical for risk-adjusted positioning.
And I felt two things. I felt that when the hate dissipated, that the price would go up all by itself. But I also felt, and expressed on your show, that in prior precious metals bull markets, after the momentum in gold attracted generalist participants, that silver would begin to outpace gold. Both of those occurred. When the hatred went away, my reason to own silver went away. And when it went away, I had to ask myself, is silver the best place to express my speculative technique? And the answer became no. Paradoxically, the silver stocks became better speculations than silver itself. If I sold my silver and transferred the money into silver stocks, if the silver price continued to go up, the silver stocks would express that. Ironically, if silver traded sideways, the silver stocks were priced in the market to discount $45 silver. So the better silver stocks could go up even if the silver price didn't go up, because their cash flows would escalate. And ironically, if the silver price went down, because the cash flows of the companies were estimated at $45 rather than $75 silver, I could expect to lose less value in the silver stocks than in silver itself. So confronted with that circumstance, and understanding that silver was in the speculative part of my portfolio, I decided to exit the silver, pay the capital gains tax. And by the way, I exited 80% of my silver, not all of my silver, and redeploy the capital into assets that were more suited to the market conditions of the time.
Silver's volatility is often misunderstood by retail investors who follow momentum blindly. As Rick Rule points out here, once generalist enthusiasm dilutes the speculative edge, silver stocks offered superior risk-adjusted exposure versus physical silver. Allocating 80% of silver into select equities allowed for upside capture even if silver prices were sideways or declining, leveraging underlying cash flows priced at $45 loans versus $75. Investors ignoring this nuance may misallocate capital. Next, Rick Rule shows how strategic redeployment from commodity to equities can optimize speculative positioning while managing tax and market risk.
Final question, Rick. What is Rick Rule buying? What is Rick Rule selling? Your latest 3 trades, I mean, what did you bought? What did you sell?
I don't want to say what I'm buying because I'm buying them. And I don't want 30,000 Triangle Investor subscribers to compete with me.
40.
Okay. Well, there are some fairly high quality gold juniors that have some risk left, that if they are successful, as I hope they will be over the next 5 years, will be taken over. And they are uniformly off 40%, 45% in price in the last 2 months. So I'm on the bid. Before that, before the Persian Gulf, I was on the bid for 5 or 6, I think it's 6, microcap oil companies involved in conventional exploration offshore in frontier markets. The increase in oil prices as a consequence of the Persian Gulf conflict has made those companies beyond my reach. The prices escalated as a consequence of the oil price quote, so I'm not able to buy those anymore. So where I'm really on the bid right now is a fairly select group of junior gold companies. If the conflagration in the Gulf continues, and if, as a consequence of that, we see a more synchronized global recession, and hence a major sell-off in global equities.
Recent 40 to 45% declines in junior gold stocks create opportunities that most investors overlook. As Rick Rule points out here, selective bidding on high-quality juniors allows positioning for potential takeovers over the next 5 years, while oil microcaps became inaccessible due to Persian Gulf price spikes. Understanding geopolitical impacts, synchronized recession risk, and market illiquidity is critical to avoid chasing frothy sectors. Retail investors often miss these low entry points in fear-driven sell-offs. Next, Rick Rule discusses why disciplined selection in juniors can outperform broader equities during geopolitical and macro turbulence.
If we see economic weakness make the copper price go down, as an example, I'll be a broad-based buyer. And if I do that, I'll go back to the best of the best. If we were to see, and I'm not saying we will, but if we were to see a 50% decline in general equities prices as a consequence of an economic slowdown, you'd see me buying Franco, buying Wheaton, buying BHP, buying Glencore, buying Rio, buying Anglotech. I'd buy the 10 or 12 lowest cost, most muscular commodity producers worldwide. And that would likely be, I'm 73 years of age, the last major trade of my life. I would suspect if I got a 50% off sale in a sector that I think will enjoy 300% price escalations over 10 years, if I could lock myself in a 5 or 6 bagger, a fairly certain 5 or 6 bagger for 10 years,
Of course.
what else do I need to do?
Yeah.
I mean, Lucien, I promise, I'll still be conducting interviews like this until they carry me out dead. But in terms of deploying my own capital, that would probably be all I'd need to do.
Excellent. When you mentioned gold juniors, did you meant gold developers or small producers? What did you meant with gold juniors?
Yes, and yes. There are a couple of explorers, pre-development companies, that look to me like they have 10 million ounce plus discoveries. And their share price has been cut in half. Their deposits didn't get cut in half.
Yeah.
So there are those. If I'm right, if these are 10 million ounce deposits, they will be taken over, and they'll be taken over for eye-popping multiples. There are some developers that are selling at 30 or 40% of net asset value. Now, I think that the discount to net asset value will go away as time goes on because you're closer to production, right?
Yeah.
And then there are some producing companies, both single asset producers and multi-asset producers, where if their share prices don't increase, they'll be taken over by majors. Before I buy any company in today's climate, in today's sell-off, what I'm looking for is a company that is strategic as an acquisition to a bigger company, where either the share price increases organically because of markets or they get taken over. I'm looking in every case at assets that are strategic to somebody.
Massive headline drops often mask underlying opportunity in commodity equities. As Rick Rule points out here, a hypothetical 50% sell-off in general equities would be a strategic entry point into the 10 to 12 lowest cost, most robust global commodity producers, targeting potential 5 to 6 baggers over a decade. Investors frequently panic at headline declines, ignoring fundamentals like deposit size, net asset value, and acquisition potential. Strategic positioning in explorers, developers, and producing companies during sell-offs allows compounding upside while mitigating risk. Next, Rick Rule shows why identifying acquisitions and strategic assets defines high conviction investing in commodities today.
The tension, the thing in Strait of Hormuz, the situation is obviously escalating and brought renewed attention to supply disruption risk. From your perspective, how vulnerable are global energy markets today to a real interruption over there?
If this war, let me rephrase that. If the interruption of hydrocarbon exports from the Persian Gulf continues for 2 or 3 more weeks, we're going to have to begin to ration oil and liquefied natural gas by price, not by availability. And that'll be ugly, really, truly ugly. Right now, several countries, Japan in particular, are able to get by on their own strategic petroleum reserves. The United States, of course, as being a big producer, is in very good shape. But places like Northern Europe, which formerly relied, as an example, on Russian natural gas, now unavailable, pardon me, let me kill this, and East Asia, I think 2 weeks out, 2.5 weeks out, if the conflict goes on, are in real trouble. The floating inventories of oil referenced by the International Energy Agency seem to be less prolific than we thought they were, or else they are floating in the Persian Gulf and unavailable to foreign buyers.
Geopolitical headlines obscure near-term systemic vulnerabilities in energy markets. As Rick Rule points out here, even 2 to 3 weeks of Persian Gulf supply disruption could trigger price rationing for oil and LNG, with severe consequences for Northern Europe and East Asia. Strategic petroleum reserves provide a buffer, but floating inventories may be effectively inaccessible, leaving markets tighter than public figures suggest. Investors ignoring regional exposure risk will face unexpected shocks. Next, Rick Rule discusses how these disruptions may ripple through global energy supply chains, affecting portfolios and commodity-linked equities.
I don't know how long this circumstance lasts, but to the extent that it lasts 2 or 3 more weeks, I think the implications have the potential, at least for the near term, to be profound. It's important to put these in context, too. You read in the press that the Persian Gulf accounts for 20% of the world's petroleum supplies. It's actually worse than that, because it accounts for almost 50% of the world's export supplies. There are other parts of the world that are much more self-sufficient, like North America, the United States and Canada, Mexico, things like that. The Persian Gulf also accounts for almost 50% of the world's supplies of liquefied natural gas, a separate, segregated but related market. 35% of the world's helium, and the semiconductor and computer industry worldwide relies on helium. Its primary use is not to blow up balloons.
Yeah.
30% of the world's supply of export aluminum, 40% of nitrogen and nitrogenous fertilizers. This will have, if the war continues to go on, that's the if, this will have profound implications. And I suspect, I am not an economist, so take that into account. But I would suspect that if the war goes on for 2 or 3 more weeks, that this could have profound implications for the onset of recession in the global economy. And the damage to producing facilities and the damage to confidence in energy markets on a global basis, if the war continues to go on, likely have implications that go on 5 years or more. Those implications will only, of course, be available to us over time, not ahead of time.
Media often understates the Persian Gulf's outsized role in global exports. As Rick Rule points out here, the region supplies nearly 50% of the world's petroleum exports, 50% of LNG, 35% of helium, and critical shares of aluminum and nitrogen fertilizers, with ramifications for semiconductor production. Even short-term disruption of 2 to 3 weeks could ripple into recessionary pressures, facility damage, and lasting confidence shocks. Investors underestimating this exposure risk, misjudging global macro dynamics and portfolio vulnerability.